My name is David Blanchard, and I'm a principal with Digital Benefit Advisors. I'm going to begin the conversation today, but we are excited to have you join us on this exciting topic of ACA employer reporting. We really structured this today to be a very practical discussion. We've had a lot of positive responses to the webinar, and we're excited to have you on with us today. We're going to be talking at a very detailed level at second half of the presentation about what you need to do. And that was the feedback that we've gotten from clients and prospective clients over the past few months, is not only do we know that we need to take some action, but that the exact specifics of what we need to do are still kind of mysterious. So between myself and Paige and Bryden DeWitt from WilliamsMullen, we're excited to get through some of these actual very practical and tactical elements of the new ACA employer reporting. Before we get into the detail, I do need to put up a fun compliance requirement, but this is tax discussions. We're talking about tax forms. We are not tax specialists, but these are certainly the rules for the benefits teams for an employer. And as you can see from this disclaimer, we just need to make sure that we're clear about our position with this in the relationship that we have with you. So for today's webinar, we are assuming that everyone on the call is comfortable being a 50 or larger full-time equivalent employer. And we're not going to get into are you or are you not a 50-plus FTE client, but we will certainly be able to answer those questions if you have a need later on. We're also going to assume that most folks on the call know the basics of what's going on. We will certainly talk about the key elements of the reporting and the requirements, but this is sort of a 201 level of detail and review. We can certainly provide this information to you afterwards. We're recording this PowerPoint and presentation, and we do have a handout that we can provide with some information later as well upon your request. And we do want to make sure that people recognize that this is relevant to both self-insured clients and fully insured clients, but there are some nuances that will come up with each division. At this point, I'm going to turn it over to Bryden from WilliamsMullen to go over a couple elements of the details of what's going on with the overall tool.
Well, good morning, everyone, and thank you. Thank you, David. So, I think we're having a little technical problems.
No, we can see it.
Okay, I'll keep going. So, why does the IRS require the Form 1095-C and 1094-C? Well, it's not just for fun. This is the forms are intended to comply with the IRS or with the Internal Revenue Code sections 6055 and 6056 reporting requirements for applicable large employers. And this form is the mechanism by which the IRS will be assessing penalties for the employer's failure to comply with the employer mandate. So every year, this is going to be just something that's going to be part of our annual processes, just like the Form W-2, where we are going to be collecting monthly information on employees, whether they've been offered health insurance, and then reporting to the IRS annually to show that the employer has complied or hasn't complied with the employer mandate. I want to point out that this is the exclusive means for the IRS to enforce the employer mandate. Maybe some of you already received notices from state exchanges. Maybe you will in the future. But if an employee, full-time employee, goes to an exchange and claims that he or she was not offered health insurance and they're working full-time hours, you may receive an assessment or a notice from the state exchange, either the federal exchange or the state exchange, notifying you that one of your employees has applied for premium tax credit, has applied for coverage through the exchange, and we believe qualifies for premium assistance. The qualification premium assistance is the trigger that would cause the employer to be subject to the employer's shared responsibility payment, that would cause the employer to be subject to the penalties. And so there is a process with each state exchange for appealing that decision. And so you can go through that process, you can appeal the decision with the state, you can get a favorable outcome from the state exchange. The IRS has made it clear that that has no bearing on whether the IRS will then determine that you owe a penalty. So you have the state exchanges that you're dealing with. That is a completely separate process from filing the 1095-C and 1094-C. The 1095-C and 1094-C are the exclusive means for the IRS to assess the penalty. So let's go to the next slide. So what do these forms do? Generally, they are due on or before February 28th of each year, but if you file the form electronically, you can file it with the IRS by March 31. Because February 28th falls on a Sunday in 2016, the actual deadline for this first filing is March 1. And then just like with the Form W-2, you will be providing employees with the Form 1095-C, and those are due generally on or before January 31 of each year, and again, this year, January 31 falls on a Sunday, so you have an extra day to file it or to provide it to employees by February 1. So this is not just an IRS reporting requirement. You have to file it with the IRS, but you also have to provide the forms to employees. If you're filing at least 250 Form 1095-Cs and 1094-Cs, then it must be filed electronically with the IRS. So the reporting deadline is fast approaching. As the summer is ending, we're heading into fall. Pretty soon we're going to have these reports ready and filed with the IRS. And here's why we care. There can be pretty significant penalties if you fail to comply. And Congress just increased the penalties. In fact, last month the Trade Preferences Extension Act was signed into law, and that it increased the penalty per return from $100 to $250 for failure to comply with these reporting requirements. It also increased the maximum penalty from $1 million to $3 million. So this is a very recent increase in the penalties for failure to comply with the Form 1095-C and 1094-C filing requirements. The IRS, however, has said that for this first year, if you comply in good faith, so if you make a good faith effort to fill out the forms, which are pretty complicated, as we'll learn in a moment this morning, if you make a good faith effort to fill out the form and you have a mistake or you just didn't do it exactly right, you're not going to be hit with these penalties as long as you made a good faith effort to comply. However, failing to file the form at all is not a good faith effort. So if you completely whiff and you do not file these forms, you will be subject to these penalties. And it's a per return penalty. It's a per full-time employee penalty if you fail to file the forms. So who will complete the form? And I think before we go into specifically who will complete the form, I think we need to back up and think about, well, who is responsible? If you are an applicable large employer, which we're assuming everyone on this call is, that you have at least 50 full-time employees, that means employees who work on average 30 hours per week, then you are required to file the Form 1095-C and 1094-C. What if you're an ALE and you just don't offer health coverage? You have to file. In fact, the IRS wants to know if you have not been offering coverage. And you may say, well, we're telling the IRS, assess a penalty against us. Well, it's better to, first of all, it's required by law to file the form, but you don't want to be hit with the employer shared responsibility penalty and the penalty for failure to file the Form 1095-C and 1094-C. In a few minutes, we're going to talk about control groups, but you can qualify as an applicable large employer if the employer and its subsidiaries and affiliates combined exceed the ALE 50 employee threshold. That you have to file, but each entity with its own EIN is responsible for filing the form. This requirement also applies to nonprofits and governmental entities. Often in the benefits world, we have a dividing line between for-profit and governmental employers and private employers. That's the dividing line for ERISA. That's not the case here. So nonprofits and governmental employers are subject to this requirement. Governmental employers, however, can assign responsibility for the form to what's known as a designated government entity. So one governmental unit can assign or delegate to a related governmental unit the responsibility for filing the form. So I just wanted to back up and say, if you're an employer, you may be relying on a payroll vendor or a external ACA reporting vendor, but you as the employer are responsible for making sure these forms are filed. So practically speaking, who is going to do this? Well, there are three basic options. You have a payroll vendor. Your payroll vendor may be collecting the data. It may be agreeing to file the form. You can hire a specialist, an external ACA reporting vendor, or you can do it yourself. My clients who earlier in the year were thinking they were going to do it themselves, what I've noticed is a lot of them are going to external providers or getting their payroll vendor to do it because it's so complex. So at this point in the summer of 2015, with these deadlines looming, it's important that you've identified the organization who's going to be filing the report. As we're getting closer to the deadline, vendors are increasing the cost, so you would save money by doing it earlier. And then you need to understand the extent to which your vendor that you select is guaranteeing that they're actually going to perform and get the forms filed on time. If you're using a payroll vendor, don't assume anything. This form is very, as I said, these are potentially high penalties for failure to comply. So make sure that you know that your payroll vendor isn't just collecting data and they're going to dump it in your lap in December and say, well, good luck, file the form. Make sure now that you know whether your payroll vendor is going to be handling this. In a few minutes, we're going to talk about the specifics of the form, and one of the most important parts of the form, completing the form, is coding. There are several codes that you put on the form to tell the IRS different information about offers of coverage. You need to understand that the payroll vendor is going to be making the decisions on what codes are going to be put on the form. And the slide here says who owns the liability. Well, again, no matter who's doing the form, the employer owns the liability. So if you've engaged a payroll vendor or an external ACA reporting vendor, you need to make sure that service agreement has strong indemnification language that protects you if the payroll vendor makes a mistake or the ACA reporting vendor makes a mistake. So even though you may have delegated the responsibility to a vendor, ultimately the employer is responsible and would face the penalties, not the vendor. If you're using an external ACA reporting vendor, now we're in a situation where you need to make sure that your payroll vendor is coordinating its efforts with your external ACA reporting vendor. So you need to get both parties on the same page. You know if there are any additional costs that the payroll vendor is going to charge you for putting in data into the format that your ACA reporting vendor requires. And again, you need to understand the services that are going to be provided by your external ACA reporting vendor. Will there be a call center? Because remember, these forms aren't just going to the IRS, they're going to employees. And especially in the first couple of years, it's going to be, it's going to generate a lot of questions for employees. And so who is going to handle the volume of additional questions going to HR? Will your external ACA reporting vendor be offering a call center, for example, to handle the questions? And then, again, the vendors are also increasing costs, their fees, as we get closer to 2016. And I know some vendors are scaling back the services they're providing because they've been overwhelmed, which normally in business it is a good thing for them that they're getting a lot of clients, but they're getting so overwhelmed with clients that they're starting to scale back what they can promise. So, again, the earlier you can get this process underway, the better. David, can you recommend some external reporting vendors?
Yeah, thanks, Brad. So on the slide here, we've got a handful of reporting vendors that we have reviewed. You'll notice that ADP and Paychex and Dominion Payroll are on the roster as well. Those are obviously payroll vendors. They also have modules for the ACA reporting. The element to really remember here is that there are costs associated with the ACA reporting typically, and if they are not costs associated with it, we've seen a a lot of vendors out there in the market offering these services. We would just caution you to ensure that you're not also signing up for something else. In particular, granted this is very relevant to our business as your benefit consultant in some cases, some of these vendors said, well, we'll do it for you, and they'll slip in a little language that says, and we'll also become your agent, which is not typically what you're interested in doing in this type of decision process. So just be aware of that or ask for some guidance from your benefit consultant. The next section, I'm going to turn it over to Paige. We do have a handout for those lists with some contact information of the vendors and a little bit more detail. If you're interested in that, just reach out to us or to your account management team, and we will provide that detail for you. The other thing I neglected to mention at the beginning of the meeting is that we have gotten some questions from the audience. We are collecting those questions, and we're going to be answering those questions after the presentation. So just be aware that we will consolidate those questions and get back with you on that. So thanks, Bryden. I'm going to turn it over to Paige now, and she's going to get into a lot of the very detailed elements of the program and how to code and things like that.
Thanks, David. So now we get into a very detailed part of the presentation, and hopefully you will find it informative, and I won't put you to sleep with going into too many details. So the first thing that we want to talk about is the ownership issue. So there are several things to consider with this. Is the employer a part of a control group? Do you want to file for specific divisions, even though it may be all one employer and all one tax ID number? Are there multiple tax ID numbers that need to be addressed, such as you have set up a charitable foundation as a part of your organization, but you've set it up under its own tax ID numbers, and there are actually a few employees who work under that tax ID number, even though all of the benefits, all of the payroll is being handled by the parent company. And, you know, the issue is, do you need to file more than one 1094C, and who has to file the 1095Cs? But each company, if you have at least one employee, will have to file a 1094C. If one company of that group will have to aggregate the data for all the companies under an authoritative transmittal, and, you know, one company could complete the filing of all the forms. However, if you do have separate tax ID numbers, then you will have to have a separate 1094C, which is the transmittal form for each company. Again, it could be a situation where a company has multiple divisions. Let's say the home office is in Virginia, and there's a satellite location in Minnesota, and the company decides they want each division to file their own 1095C forms. And so each company would, each division, would then have to complete the 1094C transmittal form, but the home office would be the one, you know, dealing with the authoritative transmittal part, which would add up all of the count of the 1095Cs that are being filed. With the 1094C, important to note, you're completing this form regardless if you're fully insured or self-insured, and whether or not you offer coverage. So now let's go ahead and get into some of the specifics of the form. So coding can be complex, and there are special considerations on how you may handle people who are on COBRA, if you offer coverage to retirees and they're covered under your plan, variable hour employees that still may be in their measurement period, and we do have some specific examples as to how to handle these different situations later in the presentation. So very quickly, just some general information that's required on the 1094C. It's really basic information about the employer, how many 1095C forms are being submitted, number of full-time employees, number of total employees, whether or not transition relief applies, and then information about companies that need to be aggregated together. And so on the 1095C form, which this is the form that's going to the IRS, but it's also going to the employees, you know, generally it's basic information about the employee and the employer, you know, whether or not employees, spouses, and dependents have coverage, if any safe harbors apply, and, you know, what's the lowest, what the lowest cost for employee-only coverage is that's being offered. Now, I do want to make a general statement here, because as you see as we get into the presentation further, we've used screenshots from the 2014 forms. Recently, you may have seen that they just updated the draft 2015 forms, but they're still in a draft version and have not been finalized. And I will point out there were a couple of differences that I saw from the 2014 forms, nothing major. You know, all of the coding was still the same. They still had the same questions on the line numbers. They just may have moved it around a little bit. And so I'll point those out as we go through the process. All right, so let's dig into some of the details. So here we're looking at part 1. So lines 1 to 16 are general information about the employer, and unless it's a designated government entity completing the form, then the employer is going to complete lines 1 through 8. If it's a designated government entity completing the form, then they're going to complete lines 9 through 16. So very easy, basic information. Line 18 is showing the number of 1095C forms that are being submitted by that employer or division of the employer. Now for line 19, in 2014, it shows under Part 2, but in the draft form for 2015, it's showing under Part 1. The question's still the same, they just moved it. And so for this line, if a group is part of multiple groups, so whether it's separate divisions, filing, or they're part of a control group, then the group who is filling the master form out or the authoritative transmittal form would check this box. Otherwise, it would be left blank. And so then moving on to line 20, this is going to be the total number of 1095C forms that are being filed for all the companies together. And so just to refresh, and as we get into the 1095C, if it's a situation where it's 2 divisions, but it's the same employer, same tax ID number, and you have an employee who works in both divisions over the course of the year, then only one of the divisions is going to be completing the 1095C for that employee with all of the information from both divisions on it. So that employee would count as 1. Now, if the employer is part of a control group of companies, so you have multiple companies with separate tax ID numbers, and you have one employee who may have worked at one company for part of the year and another company for another part of the year, then each company is going to fill out a 1095C form for that employee based on the amount of time they worked under that employer. And so that would be, that employee could potentially have 2 forms or more if they worked for 3 or 4 companies in the same group, and would be counted multiple times. So line 21 gets checked if the employer, it gets checked yes, if the employer is part of a control group with several companies with separate tax ID numbers. If it's just separate divisions of the same company, you would not check yes under line 21. So now we get to line 22. Line 22 has several options that you could choose, and it's possible that you could choose more than one option if it's applicable. So I want to briefly talk about what the different options are. So on the next slide, we'll see a chart that helps us to identify what each of these, what the requirements are for each of these options. So for the qualifying offer method, the employer must offer a minimum essential coverage to at least one employee for all calendar months. The coverage must be offered to spouses and dependents in addition to the employees, and the coverage must meet the minimum value requirements, and the safe harbor that the employer uses to determine the affordability of the employee costs must be based on the federal poverty line, or FPL. The qualifying offer method transition relief, which in parentheses you'll see it has 2015 because this option is only available for 2015, is similar to the qualifying offer method. However, a couple of subtle differences. You still have to offer minimum essential coverage, but now it's to at least 95% of your full-time employees for at least 1 month in the calendar year. You still have to offer to spouses and dependents in addition to employees, and your coverage has to meet the minimum value requirements, and your affordability calculation must be based on the FPL safe harbor. Now, as I'm going through this, I mean, the issue here is if you check one of these, it could potentially help you streamline according to the IRS, but you'll see it doesn't give you a whole lot of relief. Your reporting requirements, depending on which method you've selected, and then it also helps, you know, as they're determining penalty viability, like the next method with the Section 4980H transition relief. In this, you're checking whether or not you qualify for any of the transition relief. And honestly, in looking at the requirements here, most employers are probably going to check this because definitely for the groups that are 50 to 99 size, because the penalty was delayed to 2016, so you're qualifying for the transition relief to have the penalty delayed, so you're going to want to make sure you check that box. For the 100-plus groups, if you have a non-calendar year plan, so that the penalty wouldn't have potentially applied until April, if you're an April plan year, then if you qualify for the transition relief for a non-calendar year plan, you're going to want to make sure you check this box. Or in addition, in 2015, the percentage of employees that you offer to in order to qualify as offering coverage is 70% versus 95%, which gets reinstituted in 2016. So you're going to want to, for the 100-plus groups, you'll want to check the transition relief box if you qualify for that as well. Now, the last method is the 98% offer method. So in this situation, you need to offer minimum essential coverage to 98% of your employees for all calendar months. You must offer to dependent children, so dependents, not spouses, in addition to employees. You could offer to spouses, but it's not a requirement to meet this method. And then, of course, your plan needs to meet the minimum value standards, but instead of just doing the FPL for your safe harbor on the affordability calculation, you could do any of the three methods that are viable. So the box one of W-2 or the rate of pay as well. So how does this help you? Well, essentially, the IRS says it streamlines the reporting and offers you an alternative method if you're doing a qualifying offer. But as you can see, you don't get a whole lot of relief here. So on the 98% offer method, I'll start with that because that's a little bit easier. The only thing that you avoid is filling out column B on the 1094C Part 3 form, which is just showing your total number of full-time employee count. And then if you do either of the qualifying offer methods, then if you use code 1A, signifying that you made a qualifying offer to employees on the 1095C form, then you wouldn't complete line 15, which is just your lowest cost employee only rate for coverage, and you could have an alternative method of sending the 1095C information to employees. Now, you still have to send the 1095C to the IRS, so you got to complete it anyway. But you can see on the bottom of the screen the limited information that you have to provide to employees. Now, most of this information is on the 1095C anyway, and you would end up having to create this additional form versus you've already got the 1095C form created. So is it worth the trouble of creating a new format to provide this information, or since you have to complete it anyway for the IRS, just also send a copy to employees? So in my opinion, it doesn't really get you a lot, with these different offer methods. So to continue on with the 1094C Part 3, this is where you're indicating whether or not you offered minimum essential coverage to your full-time employees. And remember, full-time employee is based on the ACA definition, not whatever your definition may be, so 30 or more hours per week on average. If you check the transition relief in line 22, then you can check yes for all 12 months that you offered minimum essential coverage. Again, as we talked about in column B, this is where you're indicating your full-time employee count. If you did check the 98% offer method, then you don't have to fill this out. If you did not check that, you need to fill that out. Now, keep in mind, the only way you can put in a count for the all 12 months is if indeed your full-time employee count was the exact same for all 12 months. Otherwise, you will be filling out the monthly totals. The same with your total employee count. Now, your total employee count, this is truly a total employee count. It includes your part-time people, your variable hour people, your seasonal employees, even if they're not eligible for benefits. This is your total employee count that goes in here. And again, unless it's the exact same for all 12 months, then you're going to have to fill in each monthly amount. Column D is only going to get checked if you were part of a control group. If you were not part of a control group for the entire year, then obviously you check the months where that applied. Maybe you had a single company and then at some point in the year you changed ownership, brought in a partner, they had other companies, and so depending on the rules, if they're satisfied for a control group, then maybe the latter part of the year you were under a control group situation and not in the beginning part. And then column E is where you indicate whether you're 50 to 99 transition relief by putting in code A, or if you're 100 plus transition relief, then code B. You would only put in one code or the other because you're determining whether you're 50 to 99 or 100 plus based on the prior calendar year enrollment count. So you would be considered 50 to 99 or 100 plus for that entire year, regardless of what your actual enrollment did. All right. So now moving on to Part 4. Part 4 is only completed if you checked yes on line 21. And so that, remember, is where you indicated that you were part of an aggregated group of companies. And this is only completed on the master form or the authoritative transmittal. So even if you are one of the individual entities, if you haven't been designated to complete the master form or the authoritative transmittal, then you won't be completing this information. And so what this does is this tells all of the companies and their associated tax IDs that should be grouped together. All right, so that's a lot of information for the 1094C. So now we get to move over to the 1095C form, and this is the form that not only gets sent to the IRS, but it also gets sent to your employees. And again, whether you're fully insured or self-insured, you have to complete this form for all employees who were a full-time employee for at least 1 month during the calendar year, whether or not you offered coverage. All right. So, Part 1, again, fairly easy. 1 through 6 is general information about the employee. 7 through 13 is general information about the employer. So we can move on to the fun stuff in Part 2. So in Part 2, you don't see the header line that says Part 2 actually because of the red box. But just so you know, in the draft 2015 forms, this is where it changed. In that header row, they put a box over to the right-hand side of the form that says the plan year start month. And in the draft instructions for 2015, it indicates that it's most likely going to be optional to complete that in 2015, but then it will be required to complete in 2016. But it is possible that that would change, as they finalize the form, because that's not final. So that's the difference there that I saw between the 2014 form and the draft 2015 form. Okay, line 14 is where the fun begins.
And I might interrupt.
Sure.
So this is, as Paige said, this is really where the rubber meets the road. Whether you are using a vendor or not, you're going to need to make sure that these codes are appropriate for your population. So Paige has got a lot to review with the codes, and you've probably said for the past 10 minutes of listening to this that, wow, I am definitely hiring a vendor no matter what now, but I just don't want to touch this at all. You probably will have to do something here because you're going to need to coordinate with that vendor about these specific codes. So I'll just throw it back to Paige now, but that is something that we're making sure, as one of those questions that Bryden mentioned, was to make sure that your vendor is doing these and are they actually completing the code determination. Right, yes. Okay, so you can see we have several indicator codes that you could use from 1A all the way to 1I. So if you indicated that you were doing a qualifying offer or qualifying offer with transition relief for 2015 on 1094C, then you can put code 1A in the box. You don't have to. If you put code 1A in the box, then you would not complete line 15. So by putting code 1A in there, then you don't complete line 15. However, 1B, C, D, and E
all means minimum essential coverage and minimum value coverage was offered to the employee, and depending on whether or not you're offering coverage to spouses and or dependents, you can see there are different options there. 1B is only offering to employees, C is employees and one dependent, D is employee and spouse, E is employee, spouse, and dependent. So you could, if you're offering coverage to your full-time employees, their spouses and dependents, you could put 1E in line 14. Now, 1F is if you're only offering minimum essential coverage to either the employee or the employee, spouse, and dependents. 1G is used for a non-full-time employee that's enrolled in self-insured coverage. For example, and we'll look at this in more detail in a minute. For example, if you cover retirees and the person was retired for the entire calendar year, then they're not a full-time employee, but they are covered under your plan, and so you would put code 1G in for that. Now, code 1H is if you didn't offer coverage. So this could be a variety of scenarios. So let's say you had a variable hour employee, their measurement period ended May, and they were deemed to qualify as a full-time employee and be offered coverage for the remainder of the year. Then for January through May, you're going to be using code 1H because you did not offer them coverage. Now they weren't qualified, and we'll see what happens in the 2 series code, which code you'll use to indicate that they weren't a full-time employee. Or it could be if a person who terminates employment that's a full-time employee and they don't accept COBRA coverage, then you're going to use code 1H for the months where they did not accept the COBRA coverage. And then code 1I is used if your employee, spouse, and dependents did not receive an offer of coverage, or it was not a qualifying offer of coverage, or they only received a qualifying offer for less than 12 months. So when would this happen? For example, remember back the qualifying offer transition relief for 2015 only, you only had to offer to 95% of your full-time employees to be considered as having offered coverage. So if you have an employee who's in that 5% that didn't get offered coverage, then they would be listed with code I. So let's look at some specific examples. Full-time employees are generally very easy. If an employee is full-time for at least 1 month during the calendar year, then the employer must provide them with a 1095-C. If they happen to be a variable hour employee and they're in their measurement period for the entire calendar year, then the employer does not have to furnish them with a 1095-C form. Remember, we talked about if you're making a qualifying offer, you check that on the 1094-C form, then you can use code 1A, but you have to remember that your safe harbor on the affordability calculation has to be based on the federal poverty level. Otherwise, if you do offer coverage to employees, spouses, and dependents, you could use code 1E or B, C, or D. If they apply, like if you're not offering coverage to spouses, then you would be using one of the other codes. Now, if the employee was not employed for the full 12 months, then you're going to use code 1H where they were not employed unless they enroll in COBRA coverage. So let's go ahead into the next example, which is an example of a COBRA employee. So we have an employer, their plan runs on a calendar year basis. So Jane Doe is a full-time employee, she's enrolled in the coverage, and she terminates employment on 6/17/2015. If she accepts COBRA, then it's easy. She's treated just the same as if she were still a full-time employee, and she would be coded with either 1A through E, depending on how the employer decides to code for the entire year. Now, where it gets interesting is if she declines COBRA. If she declines COBRA, then she's going to be coded January through June with code 1A or B through E, depending on how she was coded as a full-time employee. And July through December, she's going to be coded with 1H. Now, you may be sitting there scratching your head and saying, well, I did offer her coverage. I offered her COBRA coverage. So why wouldn't that be considered and coded that way? Well, since this is a form that's going to the employee to file in with their taxes, the IRS is trying to make it make sense from the employee's perspective. So from the employee's perspective, they had coverage for the first half of the year. They did not have coverage for the last half of the year. Now, most likely if they've gone to another employer and they took coverage through their plan, they're going to be getting another 1095-C from that employer, or if they went and got individual coverage somewhere else, then depending on if it's an exchange or not, then they will be getting another form indicating what happened with their coverage for the last part of the year. All right, so our next example is retirees. So it's easy. If they are retired for the entire year, then you're going to be able to complete a limited reporting for the retiree, but again, it may be that too complicated to pull them out, and it may be just easier to issue all 1095-Cs. There's not a problem with that. You use code 1G if they're enrolled in the coverage, because this does indicate that they're not a full-time employee. If they were an active employee for at least 1 month during the year, then you have to complete the 1095-C. So you would use the active employee codes while they were an active employee, use code 1G for the months where they were a retiree and covered. And we talked a little bit about the variable hour employees. If they're in their measurement period for the entire year, then you do not have to complete the form. If they're deemed to be full-time for at least 1 month during the year, then you have to complete the 1095-C. All right. Okay, so line 15 is pretty easy. You're only completing this if you use code 1B, C, D, or E, and this is for the lowest cost, employee-only premium that's off of the options that you offer. It doesn't matter if the employee is enrolled in that option. It's based on what your safe harbor is and that affordability calculation, which is the lowest cost for the employee-only coverage. For non-calendar year plans, it may change at some point during the year, so you may have two different amounts. If you're a calendar year plan, you would have one amount, most likely for all 12 months, unless you had to make some sort of contribution change mid-year. All right, line 16, the Series 2 codes. So here, again, you have codes 2A through I. They don't necessarily correspond to 1A through 1I. And multiple codes could apply. And there is a hierarchy to these codes. And so I will tell you, if an employee is covered for the entire month, then the code that's going to be used is 2C, regardless if another code applies. Now, I say that, but if you've used code 1G in line 14, you're not going to use code 2C. You'll use code 2B, which indicates that they were not a full-time employee. So code 2A is only going to be used if the employee was not employed any day of the month. So if they were employed one day during the month, then you can't use code 2A. 2B will indicate if they were not a full-time employee or if coverage ended before the last day of the month. So, for instance, if your policy is that their coverage terminates on the date of termination of employment and the employee terminates on the 24th, then you're going to use code 2B. If your policy is that coverage ends on the last day of the month, of the month that they terminate, and the employee terminates on the 24th, then you're going to use code 2C because they were enrolled in coverage for that entire month. 2C we've talked about is going to be used if the employee is enrolled in coverage for every day. 2D is going to be used for months where the employee was in a limited non-assessment. Now, we do have, when you get your packet of slides, we do have the examples of what it is to be in a limited non-assessment period. I'm not going to go through that, but in general, an example would be someone's in their measurement period during that month, or it may be they were in their waiting period if they were hired as a full-time employee. 2E is used if multi-employer interim rule relief applies, and this is essentially if you have employees that are under a collective bargaining agreement or a related participation agreement and they're getting coverage through that. 2F, G, or H, and honestly I'm not really sure that these codes are going to be used very much because most likely they're going to have been coded with one of the other codes. This is depending on which affordability safe harbor method you're using, whether it be the W-2, federal poverty level, or the rate of pay. And then 2I is going to be used if you have non-calendar transition relief. So, for instance, if your plan year is April and you qualify for the non-calendar year transition relief, then for January through March, you would use code 2I. So this is, for fully insured employers, you're done with this form now. The carrier is going to complete Part 3, but for the self-insured employers, you're going to have to complete Part 3 for those who are enrolled in the coverage. And so the first thing on Part 3, there's a box in the top right that indicates that you've provided self-insured coverage, so you're going to check that. And then essentially, lines 17 through 22, you're filling out information about the covered individuals. So their name in column A, their social security number in column B if you have it. If you don't have it, then you have to fill out column C, which gives their date of birth. And then column D indicates that they were covered for at least one day for each of all 12 months. Otherwise, you have to do column E indicating the months where they were covered for at least one day. And so, there are additional lines available. There's a continuation form if they have more than that many dependents on their policy. So now we'll take a deep breath, and I know we've given you a lot of information and it's very detailed. We just wanted to make sure that you are aware of how complex this coding can be so that you can start formulating your plan as to how you're going to fill it out. I've had several people ask me, is it possible that IRS is going to delay compliance? It's entirely possible. However, their history is to delay right before it's due, and unfortunately you can't really wait to figure out what your plan is going to be and how you're going to complete these forms because they are so complex. And so we don't want you to delay. And as we indicated earlier, a lot of the vendors have their pricing and their staged pricing so that as you get closer to the deadline, it's going to be more expensive. And, as Bryden indicated, if they get too overwhelmed, they may stop taking new clients, and then you're going to be stuck and not having a very fun December and January.
Yeah, I think so. Obviously, that was a ton of information. That was the intention of today, was to get into that level of granularity. We have collected a number of questions that we may quickly review really quickly, but I think what we're going to just do is compile the answers to those questions and make sure that they are answered to the entire group. Let's see. Okay, so we're going to look at some questions here. Hang on just a moment. Okay, so one question was, is someone available at Digital Benefit Advisors to answer specific questions later this year? Yes, we fortunately have Paige every day of the calendar year, regardless of whether she is on vacation or not. And we also have access with Bryden and with other resources at Digital and WilliamsMullen to get into some detail with you too. I think the point about making sure that you have a plan of attack is critically important right now, because you're either going to want to be using a vendor, coordinating with payroll, coordinating with your benefits administration company, or seeing if you can do this by yourself. All of these will take some time, and we don't want to have anybody waiting till the last moment to complete this.
And just to answer a couple of the other questions really quickly, I know we've kept y'all quite along, and it's been a lot of information you've had to listen to. I did mean to talk about how to determine how many employees you had that month, and the IRS gives you 4 options for that. You either use the first day of the month, the last day of the month, the first day of the first payroll period in that month, or the last day of the first payroll period in that month. And, you know, another question, you could potentially check all 4 boxes on line 22 on the 1094C if it applies to you. So that's where you were picking the 98% offer method, the transition relief, or the qualifying offer. Or you don't check any if none of them apply to you. And then on the waiting period, with the waiting period, that would be, I'd have to look at the 2 series codes really quickly. You're going to use that would be code 2D in line 16, because your limited non-assessment period, when you look at that definition, it includes the waiting period, it includes the measurement periods, and a couple other things with that. So if an employee is in a waiting period, then you would use code 2D on line 16. And we do have several other questions, so we'll begin to compile those and make sure that we get a Q&A out to everyone so that you can see the questions that were asked and then the answers to those questions. So any other, you may want to talk about the.
And we had a number of people asking about whether we could get the presentation out to the group, and yes, we will be providing this presentation to the attendees and even some folks that weren't able to attend. So no need to request that. We will be sending that out automatically. If you do have other questions, you can reach us, reach your account team, or reach us directly, and we can help you individually from there. With that said, I think that's probably enough Affordable Care Act torture and fun for a Wednesday morning. I know we've really appreciated your time. We had a lot of people on the event, on the call today, and as always, we're here to help. We can access Bride and DeWitt and WilliamsMullen for you, or you can reach us directly at Digital here in Richmond too. So we look forward to working with you on this this requirement, and as we said throughout, definitely be thinking about this as early as possible, recognizing that there's a lot of work to be done, whether you use an outside vendor or not. Anybody else have anything for the group? Okay, well, thank you again, and we hope you have a great rest of your day.